Well, all right. Well, thank you, everyone. And yeah, let's see, at 10:05 here, I think we've got the bulk of who's going to be able to join. So we'll go ahead and get started. As always, with our webinars, there'll be a recording of this that'll be sent out to everybody who registered. So if you join late, or if you have anybody joining late, not to worry, we'll send out a recording. Just one quick note for our MCT clients on the line. We decided a couple days ago to make this public. So there's a substantial amount of people on the line, big broad audience, agencies, aggregators, possibly regulators. So we're going to try to thread the needle here, not offend anybody too bad, but basically, I'm just going to jump right into it because we've got a lot to cover. So basically, what we're going to focus on here is just one aspect of the PSPA amendment that was announced, of course, on the 14th. We're going to focus on the $1.5 billion per agency caps over a period of 4 quarters. I think that, look, there's some other interesting things as far as limits on, limits on products like non-owner occupied. But as it relates to, secondary execution, for the most, really what we want to focus on is kind of what we see that having an effect on. And of course, so this webinar is going to, require some, obviously some experience in secondary. There's not quite enough time to go through all the background of kind of the reasons for some of what we're going to talk about. But for those of you who have questions, further questions, we'll have contact info at the end of this. But I'm just going to get right into kind of what, where we see this current current construct of the recommendation for these caps, kind of what we see as potential impacts of these caps, which we don't see just talking to lenders, advocacy groups, agencies, aggregators. We don't see this as necessarily obvious yet to the industry. So we want to make sure that some of these concerns are raised. And then, if and when these changes do take place, we're going to go through some, obviously recommendations on this call. Andrew Rhodes will talk about the transition. Paul Yarbrough will talk about, if the transition kind of from a lender's perspective of the move from cash to MBS. Phil Laram will talk about the servicing, a couple minutes on the servicing aspects. Obviously, any piece of this presentation we could spend hours on. So we'll try to cover as much as we can in the time we have. But just to kind of level set here on where we see some potential issues. Look, on the first bullet point here of possible execution degradation, this isn't obvious, right? The story, or kind of the narrative, the theoretical narrative, I should say, of, the agencies, kind of hosing the independent lender and having the independent lender, letting the independent lender take control of their own specified pool pay-ups, their spec pool pay-ups, because the agency is not passing through everything to you. Theoretically, that makes sense. It's a good narrative. It's a believable story. In practice, to the agency's credit, we're just not seeing that. We're seeing substantial pay-ups when you compare what we see in from the broker-dealer spec grids. We're seeing substantial, if not all, and in some cases more than what we see at the broker-dealer side, pay-ups pass through from the cash window to those spec-specific products. So One thing we're going to focus on is the execution. We have developed a comparison tool for our clients, which we are launching at the beginning of next week. And we're going to open up that for the industry as well, because we simply don't see, we haven't seen a situation where for a mid-sized lender, a lender that would be affected by these $1.5 billion over 4-quarter caps, we just have not seen a situation where MBS has been superior to cash, even when you take a look at, and especially I should say, when you take a look at what that lender can get in the spec markets given their volume and their product profile versus what they're getting at the cash window. So we're going to go into that into further detail. The decrease in transparency of the and kind of the ability for a lender to pass through the spec payups. This is actually an extremely important topic. I'm actually going to come back to this bullet point. Ben Aiken, for the third bullet point here, is going to go through the potential effect that this might have for kind of a downside effect that this could have for smaller aggregators and how that could consolidate power in the large aggregator space. Again, we have great relationships with all of the large aggregators on the phone. But look, it definitely, as we saw in March and April of last year, it's good if we can have a competitive market, right? Because there's unforeseen issues that can occur and cause certain lenders, for a variety of reasons, certain aggregators to step on their price. And so we need as competitive of a market out there and correspondent as possible. And then, look, we like to stay in our execution lane, so we don't get into the risk. Look, we know that one of the reasons, as I think everybody on the line knows, one of the reasons for this PSPA amendment was to transition risk of that actual delivery, right, which right now the agency is taking to a scheduled, where it would be put on the lender. Look, bottom line, we feel that would introduce risk into the equation, right? When you remove that risk from the GSE and put that onto a independent mortgage banker, especially in a time like March and April, I can tell you that when I was doing all the webinars to all of our customers and some for the industry, it was really nice to be able to tell the lenders on the line that they were delivering on an actual. So for the principal and interest, there wasn't an immediate cash crunch for the potential of forbearance. So. But look, we're going to stay more to the execution side of things. So I want to go back up to bullet point 2, because we do feel strongly about this for the efficiency of the market. And again, this is a credit to the agencies that the cash window provides vital transparency to spec execution that small but mid-sized lenders that are going to be hit with this cap simply cannot get in the markets. So again, the only reason that these specified pool payups exist is because of the fact that there's going to be a decreased propensity to prepay, right? So the optionality, that spread, that option spread that increases rates is reduced for these loans. The classic one is like the sub $85,000 loan amount, where it just simply doesn't make economic sense for that borrower to refi given a drop in rates, because he or she cannot overcome all of the fixed costs when you compare the small incremental change in the monthly rate of a small loan, in the monthly payment of a small loan. So, said a less sophisticated way, basically the only reason those pay-ups exist is because the borrower's stuck in that higher than market interest rate loan, right? And so just from a standpoint of history, look, these pay-ups that exist should be passed to the front end. They can only be passed to the front end if there's good visibility on what they're going to be in the back end. Now, the large lenders have that visibility. They have enough contacts. They have enough dealers. They're doing enough securitizations to get good visibility. For the mid-sized lender, they just simply do not have, they're not doing enough of these securities to get good visibility on that back end spec pay up, right? So that's going to preclude them from passing that spec pay up forward. Now, the agencies will tell you, to their credit, they're going to keep the cash window available if you have to move to MBS, but they're also going to tell you that they cannot get arbitraged. And so what does that mean? They cannot allow you to change your profile to where you're just picking them off on certain products, certain spec pay-ups on cash, and going whatever is more profitable for you, MBS. So they're going to have to change that pricing. What that means is if you're delivering MBS, the spec pay-ups that they are showing you from the conduit are not what you're going to be getting. That's not what you're going to be achieving necessarily on the back end when you create your pool. So that's extremely problematic. And I just want to take, not to get too philosophical here, but I do want to kind of use a historical example here of HARP. And, if you look at HARP, and I just used Fannie Mae's 2017 summary, where they looked at 1 million loans through that single family loan performance data set. The average rate improvement that they saw for HARP refis over the period that HARP was in place was 161 basis points. So that's the original note rate to the newly refied note rate. So that's a great improvement to the borrower. National Bureau of Economic Research pegged it at 145 when they looked across both Fannie and Freddie. Let's go with the more optimistic number of 161. So if we look at that, the most active period, as we all know, was after the implementation of HARP 2.0 in 2012 and before the taper tantrum of 2013. So 2012 and 2013 were the two most active years for HARP. But what happened is during that period, there was a dramatic rise in basically the discrepancy between primary and secondary mortgage rates, what was being executed on the back end and securitized, the rates that were achieved in the securitization markets versus what was achieved by the borrower. Now, obviously, everybody looking at these dates who was in the industry, there was some nice little G fee raises there, 2 of them, in fact, in 2012, which accounted for obviously a 20 basis point increase. But a big part of what the New York Fed found when they did research here was the fact that HARP accounted for a large percentage of those refis during that period, as it should have. And the average spec pay up for the coupons that were securitized, as you can see here in this last bullet point, was 150 to 350 basis points. Now, why does that spec pay up exist? It exists because of the one and done aspect of HARP, right? And so if you think about it, these are spec pay ups that exist because of the structure of the program, which was put in place to lower rates to the borrower, okay? The reason I bring this up is these were not passed to the front end. It's not the lender's fault. If you talk to a lot of lenders, they didn't have the transparency back then. They didn't know what the spec pay-ups were going to be. Okay, so this is a really, really important historical example here when you look back up to the fact that Fannie is seeing the improvement to the borrower of 161 basis points, and you take a look at a 4 coupon pay up of 350 basis points in price, given the, that can equate to a 3/4 point rate differential. And you can see right there that you're almost talking about a 50 basis point increase in rate improvement to the borrower had that spec pay up been passed through. Now, obviously not 100% is going to get passed through, but the point is that when you look back, and the National Bureau of Economic Research, we have both of these links, by the way, and we'll I did forget to add that to the MBER's study to a link here, but they found that, in fact, obviously there wasn't lower rates. Now there's obviously flaws with the program. Obviously, a lot of you guys on the line will talk about, rep and warrant issues, and that was a substantial flaw of the program. But the fact is that once those were handled, you were still seeing, substantial pay-ups on the back end that were not getting passed through. And again, that is not the lender's fault. That's just, these spec pay-ups trade at auction. There's no way, unless you're doing these all the time. If you're doing these once a month, you just simply don't have the transparency to be able to pass that through to the front end. So again, I promise that is as philosophical as we will ever get. We don't get on the soapbox very often, but I just want to make sure that everybody understands the importance of transparency for these spec pay-ups and how they can directly affect rates to the borrower. So with that, I want to pass it over to Ben Icken, who has a lot of experience at large, at large, very large lenders and aggregators, and Ben will kind of go over, where we think the impacts are, and also speak to the effect on aggregators.
All right, thanks, Phil. Well, I guess I'm going to start off with impact as we see it on the lenders that are going to be directly tied to the implications here. So we would categorize that maybe obviously as any lender that's doing at least 1.5 billion of annual conventional production and has an agency relationship. They're clearly going to be impacted, or there's potential thereof. As well, we want to consider anybody that's close to that mark or is in a growth mode, which a number of our clients have experienced tremendous growth, and there's a lot of potential, I think, in the coming several quarters, I think, for consolidation amongst firms, which could take somebody from the territory below the threshold words of concern and throw them into the bucket with the others. We've done an analysis of the MCT customer base recently, and we've come up with about a 35% figure of clients that are within the bounds of direct impact from the scenario here. There's mitigating circumstances to that. So for one, you might have dual agency approvals, for example. If you've got dual agency approvals at 1.5 billion to each, clearly that gives you a little bit more leeway before you run into a problem. Secondly, you might be a lender that's got aptitude for delivery to the aggregators. A number of guys historically sold the aggregators, and in more recent times with the approval at the agencies have gotten used to the streamlined efficiencies of delivering to the agencies directly. Probably going to want to dust off some of your policies and procedures on post-closing, and I guess hone in that skill set again. So again, your ability to send some of your production to the aggregators, if you've kind of lessened in that direction, is something that I think in our recommendation section we'll probably go into a little bit more detail on. That being said, there's a large number of guys within our book clearly that haven't met that threshold, market participants, and really all the way down to the borrower that this far-reaching situation is going to impact. So we'd like to touch a little bit on that. For one thing, dependency on the aggregators. So this action will clearly reverse the course that was set by the Housing Authority after the last crisis when they pledged to level the playing field for the smaller lenders. So, kind of ironically, if you read the announcement, it's under the guise of protecting the small lenders, and I'm quoting here, to ensure that the cash window is for the benefit of community lenders. Each GSE will limit the volume purchased through the cash window to $1.5 billion per lender. So the implication there is that it stops the larger lenders somehow from monopolizing the cash window benefits, but the reality is that it forces the mid-sized shops to now compete with these larger shops in the securitization market. And frankly, in the securitization market, scale makes a huge difference. So the cash window really was kind of a leveling factor for the smaller shops. So this will clearly force more paper through the aggregators, as they in many cases will become a more viable execution than MBS delivery for the smaller shops. Not necessarily, based upon their inability to run optimization modeling, but based on scale. You might not hit the thresholds in order to take advantage of some of the spec and other market pickups that the larger aggregators can enjoy. So again, dependency on the middleman, aggregators will once again be on the rise. Secondly, let's talk a little bit about specs. This is going to lead to a dilution, frankly, in the spec payups that are passed along to the consumer. I know Phil touched on this already, but the bottom line is the certainty of the spec payup. So without that, not just visibility, but confidence that you're going to be able to achieve that spec payup, aggregators and lenders alike will be less inclined to push that pricing out to the borrower. So you could see situations, just by way of example, you've got the low bow, which is probably the most common spec payup. Different tranches of, you got 85, 110, 125, where right now with confidence a lender can price an 85 out to the street, knowing that one loan through the cash window could be executed. Now without the certainty that they're going to hit critical mass in order to get that spec done, they might opt to only pass through a 125, knowing that they can throw together, worst case scenario, their 85s with the 110s and the 125s, and gives them leeway. So understandably, lenders and aggregators will have to protect themselves, and so this execution will be kept and not necessarily passed along to the consumer. Then I'd say another issue to be considered is just general pricing deterioration beyond the specs. So, the reality is this: you look at the current environment. There's many large lenders that do have MBS capabilities, and with that MBS capability, coupled with cash window, I know again, agencies typically are not giving you two lanes. Some guys do have it, but even in those scenarios, or when they're given the option of picking one, many large aggregators and lenders alike have gone to the cash window, and that's for a reason. They're smart, sophisticated. They've got the capacity to make the specs work. They figured out that the cash window execution is a superior execution. They're economically motivated, and I guess the data kind of speaks for itself. So in terms of just general market deterioration, the agencies can work towards drawing a parallel, but at least in the current situation, most of the lenders have opted towards the cash window scenario. Beyond that, here's the reality of margin management. When I worked at a large lender in the past, there's volatility that's accepted on the part of the acquiring entity with regard to a loan when you give price certainty to the party that's selling it. So through the cash window, the agencies have the ability to essentially margin manage on the spot. It's dynamic. You get into MBS, between the G fees that are established and the periodic, reiteration or the changes to the buy-down grids gives less maneuverability to the agencies on the pricing. And so that creates a scenario where they have to accept a certain amount of volatility. And so just rational margin management would lead one to widen margins a bit to cover your potential, reduction in anticipated gain. So if the production is going to get forced over to MBS, to say that it rationally ought to be priced on top of cash window where they can margin manage just doesn't make sense. I think that you could make the argument certainly that there'll be a bit of a deterioration. This isn't a question of somebody trying to increase margins for gain of the entity. It's just, again, the protection of the firm's bottom line, which is going to ultimately get passed to the consumer. One last point that I touch on here is the impact that's going to be felt by the smaller lenders, and frankly will put pressure on the overall system, in that we're going to be shifting sales on a scheduled basis through the cash window, and it's going to be pushed into an actual basis through MBS. So this is going to put significant cash flow risk back on the backs of these thinly capitalized or more thinly capitalized seller servicers when it was going through the cash window, as opposed to the agencies kind of accepting that risk. When we shift it back over to MBS, again, you've got the aggregators. I'm sorry, you've got the seller servicers that are going to have to accept that risk. So a number of implications. Beyond just the obvious, am I going over that 1.5 billion? I guess that's, I'm sorry, I don't have my outline in front of me. I'm not sure who's coming next.
No, thank you, Ben. That's perfect. That's actually me. So it works out well. And Ben did a great job to stay right on track there time-wise. I definitely went over a couple minutes for the first section there. So just on the execution impact analysis, I do think because there's a few moving pieces here, there is a lot of we see a lot of noise out there and hear a lot of noise out there. And so what we've done for our customers, like I had said earlier, is we have created a comparison tool. And we'll be sending a release video out about this next week to MCT clients. But basically, it boils it down. You can load your spec pay-ups from the dealer that you choose, or you can use MCT's combined spec pay-ups that we see from the dealers that you're approved with. You load your indicative buy down grids, your indicative G fees. Notice we are not showing any of those because that's obviously a question right now from a lot of our clients, and that's definitely something that you're going to talk to your agency about if you're affected in this, and you're going to talk to them about getting some indicative grids so that we can take a look at. So the next step from there is invariably you're going to see a differential when you look at when we calculate the pricing of MBS versus cash, and more likely than not, cash is going to be better. Now, what the agencies will say, which is absolutely understandable, is that because you are delivering cash currently, their sharpest price will be how you're delivering versus MBS. That's totally understandable. It's just a little bit scary for lenders who are staring down the barrel of a potentially a 20 to 30 basis point drop in execution. So what we need to do is we need to quantify that based on your product makeup. And the problem, of course, with 2020, as we all know, and especially after Tuesday of this week, and frankly of how this week has gone, period, is that 2020, at least from a rate standpoint, not that any of us want to go over March and April again, but 2020 from a rate standpoint looks like it could potentially be pretty darn unique. And 2021 may not be so refi centric, right? I think a lot of us, there's a lot of everybody on the line here probably thinks the pressure or the risk is to the upside in rates. Not to say that that will happen, but that's definitely a possibility there. So when you look at your profile and you're trying to figure out, okay, what am I going to be delivering? It's important to look at what you think is a quote unquote normal period. Maybe 2019 was not normal, but it's probably, hopefully, a lot more normal for a lot of reasons than 2020 was. And so this enables you to, for an MCT client, because we have your historical data, you can just take your historical production. You can see up here in the top, I've taken Q4 of 2019. And the problem, of course, with doing that is I take that product, we split it out to, where all the specs it landed in on a best execution basis. Problem with doing that, of course, is that 2019 was a different rate environment versus now. So what we're going to do using the Freddie Mac mortgage rate survey is we are going to take the average of the rate survey during that period, which in this example was 370. If you just take the weekly rates of Q4 2019, and we compare that to current. Obviously, we were at 273 before this week. Now we're at 281. So we've dropped basically 90 basis points in rate to the borrower from Q4 2019 to today. And so what we're going to do is we're just going to take this historical production and we're just going to drop it by 90 bips, or actually drop it, we're going to round to the nearest eighth for simplicity. So we're going to drop it by 7/8 of a point. Now, for those of you servicing guys that are on the line, Phil Laren, who's coming up here, that definitely gives substantial indigestion because obviously on the servicing side, you couldn't make that kind of a move and still have any sort of a worthwhile analysis. For what we're dealing with here, though, is all we're looking at base pricing, and we're looking at kind of the coupons that you're originating given a given product profile. And so yes, there's been changes. The LLPA, kind of the refi LLPA adjustment, September of last year it would be one of them. But for the most part, this is going to give us the most accurate representation of what your cash versus MBS execution would look like based on the product profile that you delivered over a given period, adjusted for the rate environment. And so we are confident that this is the most accurate way to look at all the moving pieces here and to get a weighted average execution. And again, I do not, we have purposely randomized these numbers so that we're not disclosing any numbers on this call. But I would say that when you see this in the bottom left-hand corner there of the execution summary, we do see right now a deterioration, and that's not, again, that's nothing against the agencies, because they'll definitely tell you, rightfully so, that they are pricing, they're going to price to the channel that you're currently executing to. But I think it's important to have clarity. And so one thing that we are doing, because we do feel strongly about this, is we are going to open this tool up to the broader market for comparison purposes. Now, again, before we move on here, I want to make sure, we're being clear that this is only for the subset of affected lenders, right? This is not, if you're doing 50 million a month to Fannie Mae and Freddie Mac, that's great volume, but you are not going to be affected by this at all. This is for the larger lenders. The issue that we have, and we've discussed this ad nauseum between between MCT and both of the agencies. The issue that we have is that rightfully so, there's a feeling at the agencies that volumes will decrease, right? Because 2020 was a pretty unique year. However, the mindset of an entrepreneur, of a lender, is not necessarily that they will be in business to shrink. And so if you poll lenders out there, the vast majority of them will say that they will grow through acquisition, through recruitment. And so anyone who was affected in 2020, we are finding is contacting us, about this change. And that's why, we do think this analysis is going to be important, because for those of you that think you possibly are going to be affected, it's important to see what the execution difference is, because there has been some people out there that have talked about, hey, this is going to, we're definitely going to see an improvement in pricing when we move from cash to MBS, because cash hasn't been that great. That's just like we've said at the outset, that just simply we're not seeing that in practice. So as far as for affected lenders and clients of ours that might have to make this transition, I want to pass it over to Paul Yarbrough, and who has some experience with that.
Yeah, thanks, Phil. Let's see here. Go to the next slide. Guide me on that. So a lot of this will be kind of a reiteration of what stuff that Phil and Bennett kind of talked about here, but just want to make sure everybody is clear on this. So first of all, this one may seem obvious, but it's worth mentioning. If you only have one approval, meaning you only have an approval with Fannie or an approval with Freddie, it's a good idea to go ahead and seek that. If you're not already doing so, seek that other agency. Or if you are approved and that approval is dormant, let's get it going again. That way, you can help yourself relieve yourself of that $1.5 billion. And while it's not as simple as like, oh, now I get $3 billion, because you do have some limitations on what you can sell to each one. At least it does relieve you on some of that production that's fungible. Another sub-bullet point to that is, it's not listed here, is something Ben mentioned. If you've primarily been selling to just the agencies for ease of delivery, it's a good idea to kind of reinstate or at least revisit that process of getting with the aggregators, just to make sure you're prepared to offload some loans in case you are on that cusp and you choose to go cash or you choose to go MBS, and some of those aggregators, the best execution is there. Just a good idea to revisit that process of delivering loans to aggregators and getting that post-closing department up and running there, as we all know that can be not challenging, especially this day and age, but different than Fannie and Freddie. If you feel as though, like Phil said, you have that growth mindset there, and even if you're on the cusp, or if you feel like you're definitely within that volume bandwidth that says, I'm going to breach this $1.5 billion cap at each agency, definitely have that conversation with Fannie and Freddie. Start that conversation about moving to MBS. Get those indicative grids, buy up, buy down grids. Get trained up on the kind of the different, how it's a little bit different when it comes to going to MBS versus cash window. Get that process started and talk to them, and then when it comes to actually understanding the pricing of it, that's definitely something that we're here prepared to help our MCT clients out with, and definitely have conversations about the pricing differences and some of the differences in just simply delivering and selling the loans now that you are creating pools. But some of the questions you really should ask, and that are still outstanding out there, and I think even Fannie and Freddie are still working to get these exact answers, is when does that count start for the previous 4 quarters? Does it start today? Does it start January 2021? How does the accounting work on the $1.5 billion? So we need to be clear on that. That way you can be prepared if you do have to switch, or if you choose not to switch, that you can be prepared with that volume question. So can I move to MBS delivery? Be prepared, but held until the cash window limit is met. So basically, can you get both? Can you have MBS and cash options at both Fannie and Freddie? I think it was mentioned earlier, sometimes that may be an option, but the agency is going to be very particular to not be arbitrage there. So you do have to kind of thread that needle to make sure that if you do have both, if that's allowed, that's great. Let's make sure that we're executing fairly, but also protecting your best execution and getting the most out of each loan on your side. That cash window execution, if you look at a straight up execution between MBS and cash, depending on the buy-up, buy-downs, the G fees, kind of some of the other contract terms that Fannie and Freddie will give you, it may not be a great execution compared to the cash window you get today, especially when it comes to that specified pay-up that Ben and Phil have mentioned here. So what do we do with that, and making sure you're clear on, that maintaining that parity between MBS and cash if possible, and then making sure, if possible, if you go MBS, to see if you get some favorable pricing compared to where you can execute today. And then again, will they allow both cash and MBS? So if you somehow breach, if you are able to do both and you breach that cash window limit, can you just automatically go MBS right then, or can you best X between the two? And Phil just showed that MCTlive cash versus MBS comparison tool. That's an awesome tool to where it really just kind of puts it right in front of your face to say, okay, based on my previous volume, here is where I would lose, here's where I'd gain. And that's where it's either going to give you that informed decision to say, is switching right for me? Even if I am kind of on the cusp of breaching those caps, and maybe I don't need to switch because of the difference in pricing and where I can execute those pools. You can't execute every $85,000 loan into an MBS pool if you don't have enough, whereas in cash you can. You can just sell them one loan at a time. So using that tool to kind of understand not only where your pricing sits between the two different execution types, but also where your volume sits based on those different specified pools. And listen, I mean, it always helps. There's great organizations out there, the mortgage, like the MBA. It always helps, and your politicians. It always helps to kind of voice your opinion, support. Make sure everybody understands how you're being impacted by this. If you feel like you're dealing a disservice to your borrower in your area because you're not able to pass down that cash window execution, make sure that you're voicing your concerns. That way, we don't hear from just the greatest, the biggest guy on the block, right? Make sure everybody gets heard, and that way the regulators can make the most informed decisions about moving that on. So we'll move that to Andrew here on overview of moving to MBS delivery.
Awesome. Yeah, no, thanks, Paul. So I know we're kind of getting crunched here for time, so I'll try to kind of just run through this pretty quickly. We definitely spent a lot of time on this, going with the transition from cash window to MBS execution, try to keep it at a high level. And then, I'm not sure if it makes sense to bring Paul back in to get his lender perspective, because he's been on both sides of it, from the secondary side and then also the lender side. So if we have time, we'll try to get him back in to kind of, answer a question that I have for him. But just kind of taking a quick view at kind of pivoting from cash window to MBS execution. There's definitely going to be a lot of operational changes that you guys are going to have to manage, with this change. So, of course, shipping changes, execution changes for secondary, accounting changes, and then, I think the potential underwriting changes, I don't think that's really going to be affecting a lot of people, because I think if you go from a cash window execution to an MBS execution, I think it kind of alleviates some of those underwriting issues, because essentially with a uniform mortgage-backed security, you're allowed to deliver both Fannie and Freddie into that mortgage-backed security. So moving on to kind of the approval process, speaking with both Fannie and Freddie, they've both had a resounding message that it's going to be best to coordinate the move with your sales representative. So if you're approved with Fannie, make sure you reach out to the rep and discuss with them that, hey, we're looking to make the change. What's the best way for us to go about making this change? And I think that will do a lot for the relationship, and it'll do a lot for the move. So make sure you're having that conversation, with the corresponding agency that you're approved with, or both of them. In my discussions with them, they said that they are kind of developing some guidelines, that they're working to kind of put out to the market. So that's still in development, but it is something that that they are working towards. And I think that will be helpful in terms of kind of just managing expectations of the approval process, because as I'm sure a lot of you guys know, there's going to be a huge rush in trying to get these approvals, and it's not as easy as flipping a switch. Unfortunately, it's more of a I think when I was talking to them earlier, they were saying that they had a lender who had mortgage-backed security experience, and even with that experience, it still took that lender over 4 months to get approved. So they said, on the short side, it could be as quick as 3 months, but then on the average, it's probably closer to 6 months. So if you're in that window, or if you're in that kind of buffer window, or you feel like you're going to be affected, then it definitely helps to start the conversation sooner rather than later. So there's definitely some considerations that that the agencies will be able to talk to you about in terms of getting that approval process. So yeah, just start that approval process as soon as possible if you feel like you're going to be affected. Kind of going to the next bullet point, the operational challenges and benefits of the MBS delivery. When you move from selling to the cash window to MBS, it's a different process. So you're moving from single loan execution, as when a loan funds, being able to offlay it and sell it to into the cash window. Then on the MBS side, especially if you're looking at a spec product, you're going to have to hold that product on the line, on your warehouse line, until you have enough production to meet the minimum requirements for the pooling. If you're looking to pool that and not taking it to the cash window. So there's some extra dwell time on your warehouse line, so you want to make sure that you're doing a kind of a best X on the warehouse side to ensure that you're minimizing your overall cost of holding that line or holding that loan on your warehouse line. This thing about production size could be a benefit or a detriment to execution. That's kind of going to the pooling requirements, but then also when you take these pools to market, it could be if you're having smaller pools, less than $1 million or less than $5 million, those pools could be viewed differently than if you're pooling MBS securities over 20 million or over 30 million, right? You could get different pay-ups for those. So we could definitely go over all that. We're going to get into the weeds of that on future calls, but just kind of wanted to touch on that real quick. So yeah, thank you. So kind of moving to MBS delivery changes of servicing, I know they've already, Phil touched on it, Ben touched on that. It is going to be a big impact. And I think, the biggest thing to take into consideration is just the issues that we had back in March and April. Like, granted, we'll probably not run into a scenario like that anytime in the near future, but you still want to take that into consideration. So for all the forbearances that happened, during, April, May, June, if you were on a scheduled remittance, then you would have to be, sending out those payments to the, to the bondholders essentially to cover the payments that you're not receiving. So there's a lot more, a lot more capital that's involved with moving to a scheduled type of delivery. So as I was saying earlier, we're going to do more kind of client inclusive calls to get into the weeds on the execution, the warehouse piece of it, the different delivery methods. So we'll definitely have more webinars kind of going into specifics in the future where we could answer any questions you guys have. But definitely talking to your agency sales rep is a big part of this, and making sure that you're communicating with them, coordinating the move with them. We'll be right there with you to kind of help out in that process as well. So yeah, so the lender experience with Paul, I think we'll bypass this for right now, and maybe on those client inclusive calls we'll be able to get some more lender experience on this, because I know we want to definitely get into the MSR piece as well. So I think, is it Phil, or are we bringing in Phil Laren? Okay. Hey, so Phil, if you want to take it away from here.
Sure. I think both Phil and Andrew already talked about the major impact of moving from an actual selling cash to a scheduled. You're going to be responsible for advancing principal and interest, and so whether or not you've received it from the borrower, and especially if we hit another forbearance type of event, that could mean a lot, even on a conventional loans, which normally you don't have to do that much advancing. Also, should keep in mind, just as in Ginnie Mae securities, in the event a loan prepays in the middle of the month, the bondholders will expect interest through the end of the month on that loan, and so you can't charge it to the borrower, so that servicer will be obligated to pass through that interest through the end of the month. So that's a potential issue that you don't have with actual remittance. On the plus side, you get more float value because you get to hold these deposits until they're scheduled to be paid out to the agencies or guarantors. And so you get to hold getting that, and same with prepays as well. You'll get to hold the prepayment longer and get the benefit of that float. It won't be swept every night the way it is with Fannie Mae these days. So you get a little bit more float benefit. That's maybe more relevant to banks who can use those deposits Our non-bank clients can't get a whole lot of leverage from that, so at least at the present time, if rates continue to rise, then everybody will have more opportunity to get float benefit. Last point I want to hit on is if you are creating excess when you're making your decisions to buy up and buy down your G fees, and you end up with higher excess, that does have an impact on your it has a tax impact for you, because anything over 25 basis points on Fannie and Freddie, any servicing above that you have to pay taxes on that excess day one, the capitalized value of that excess, not just the excess. And just reference you to, we just did a paper on that that's on our website with CWDL, a mortgage accounting firm. So we jointly put out one that discusses this issue in more detail, and we got to kind of move along, so I'm going to leave it at that and refer you to that one. So Phil, if you want to take it away.
Well, thank you, Phil. I appreciate both you and Andrew getting us back on track there. My fault for getting us off track time-wise. So look at a lot of information in this call, like the obviously the slide Phil just went over. Phil could literally spend hours on, if not substantially more, on going through those topics. So definitely reach out. If you're an MCT client, definitely reach out to Phil's MSR group with any questions. Look, I think again, we don't want to overblow the potential effect this could have on lenders. So obviously there's going to be a there's a substantial subset, call it 75% of our client base that's not affected by this. So but what we're again, we're focused on that 25% and mainly the taking out the top 10% of largest customers, that probably makes sense eventually to transition to a because of their size, transition to an MBS delivery model. There's definitely although it's from a client or a lender unit count, it's not the majority of lenders that are affected, but it is the vast majority of cash window commitments that are affected. Just to be clear. And so look, we've heard the kind of as we've been talking through the industry, that relatively few people are concerned, and I think that a lot of industry participants that I've personally talked to are some are not concerned because they feel the idea is such a mess in a lot of ways that it'll definitely get cleaned up. But look, as your risk advisor, we can't kind of, as one of the agencies said, we can't be here to sell hope. So we have to, as the agencies are doing, they're preparing for the change. We have to do that as well. And so just on look, MBA is always, look, they did a great job. They did a great job throughout the crisis, the pandemic in March and April. And just speaking with them, there's going to be more bites of this apple as far as getting their point and our point across. So very possible that this is all eventually a moot point. But I think it's important that everybody understands the implications, and the potential downside risks. So really, if you guys have any questions for the clients that for MCT clients, it's going to be very easy for you to use that cash versus MBS comparison tool that we showed earlier. For non-customers, definitely reach out to us and we can load your data in there and to get an idea of where, given your product profile, of where your execution could go. So look, I really appreciate everybody's time. I know we're 5 minutes over. And for the MCT clients on the line, we will be back obviously with future webinars, client exclusive webinars to go over potential changes as things you know, things change. But for this, we felt it was in the best interest of the industry to kind of show some of the effects that might not be obvious to everyone right now. So I really appreciate everybody's time. And again, for the clients, we'll be back shortly with more webinars. And for the industry, frankly, hopefully it's a while, because we don't usually do these unless we see potential issues like this. So appreciate everybody's time. Thank you.